Hi everyone, welcome to mykayaplus YouTube channel. My name is JP. So you are going to watch a previously private video made for our Premium Club members. So as mykayaplus slowly renew and update our Premium Club services, we have decided to make this private video into a free content for your viewing and learning pleasure. So we hope that you enjoy this lesson and this video.
So of course, disclaimer, we will be talking about real companies, but do take note, this is just an opinionated sharing. If you still feel very interested in the companies that we're going to be mentioning, but still consider doing more research before you make any investment advice. We are just here to give our sharing, honest opinion and sharing, right? So, Chubik, maybe we just touch base back on the basics. When we click buy on a stock brokerage program, are we just looking at numbers and terminologies or company names? In actual, is that the way we should invest, which is just looking at the numbers, looking at the candlesticks?
Yeah, I think me and Dupont, we are strong believer of FA. There's a lot of people, some of people, they focusing more on numbers, short-term gains. That's why they go for trading. So if you're focusing on checking the stock based on the fundamental, then ultimately you should see every stock as a business. And if you were the owner of it, whether you think this is a potential business and whether you can gain money out of it in, let's say, next 5 to 10 years. So regardless of tech stocks or whatnot, ultimately it's a business creating some service or products that people are willing to pay for it. And then if people are willing to pay for it, there will be profit margin and so on. And at the end of the day, once all this is calculated, then you can get BD in the form of dividends, or people are having very high expectation on them, then the share price might be appreciated. So this is the fundamental of it. Buying a business is basically the true meaning behind buying a stock.
Yeah, and I like the fact that you say just now, straightforward, you believe that the company still can grow in 5, 10 years, 15 years, 20 years down the road. And here we have some true examples of companies that have really grown a lot. And you will see the price movement of the share price. Over the years, it has only been going up and up and up and up. People might argue that, say, hey, look at the slope, it's already at the historical high. Can this company still continue to go higher or not, right? So of course, if I were just to give you the share price historical movement without telling you what company it is, of course you might be bound to ask me that question. How will you know whether the company share price or the company can still continue to grow because it is already at a historical high? So here you have four very good businesses: Apple Inc., Microsoft Corporation, QR Resources, a representative from our Malaysia Stock Exchange. And you also have iFast Corporation, which is Singapore listed stock. You can see all of them, they share similar characteristics. If you put the time horizon, which is maximum, so you let the company share price stretch back up to 2008 or 1991, or even further back behind, you can see that over the years, the company has continued to grow. And what the scary thing that I see is that if you look back, say for example Microsoft Corp, back in 1991 until today, the slope or the tendency the company share price has been rising is actually an exponential kind of a pattern. Meaning to say that the share price of Microsoft from 2016 over here going up way to 2021, the share price fluctuation is actually higher compared to, say, for example, 2001 to 2006. So these are the so-called magical things that can happen if you manage to spot a good company to invest in, and as Chumeng said, buy onto it, hold onto it for 5 to 10 years, and you will see that how amazing companies can continue to grow. And of course, do take note that even though we go back the time calendar, which is say for example 2008, where there was a financial crisis, this company still continue to grow higher than the so-called temporary fall during the financial crisis. Even the one that happened last year, which is the COVID pandemic, these companies have actually grown past the so-called drop that they experienced just 1 year ago, exactly 1 year ago, when the pandemic was ravaging all around us. So the business needs time to grow, and times almost all the time it managed to climb out of every kind of a catastrophe, or even a pandemic, or even financial crisis. And it would be impossible to actually wait for a company to fall back to historical low prices, say for example 10 years ago, because this company has been creating value and has been growing as time and days go by. So when you understand why it is important to find good businesses, eventually it will link back some sort or rather to how good the company is in generating ROE, or we call it return on equity. So why do investors always check on the ROE, Junbei?
Yeah, so I think basically the whole thing about business is about generating money or generating profits, because the very fundamental of it is you invest to get a dividend, right? So this one, you need profit before you can actually give out dividends. So that's why it's very important. On the other hand, is from all these factor, it also will impact how the share price move, because people see there's having potential, the profit is growing, and so on. Then people might be actually invest more into it. So if you see the chart, I mean, we shown here, ever seen the share got IPO, then this is how the entire things works. So we as an investor on the left, and then we put in the monies. Of course, during IPO, it's the first round of thing that we put in the initial fund of it, and then the equity fund will be used by the management of the company to do all the necessary expansion. If you go through some of the IPO prospectus, then you know how they plan to use it, by when, and so on. So this is all the key thing that we will check when we look into the documents. And then from there, you will know whether they are raising fund for future growth, or just purely for working capitals or paying off debt. So all these make a difference. And ultimately, you should look for something that this money will go into something that will churn more money in the futures. And then this will be resulted in the form of earnings, and ultimately become a returns to us, be it in the form of dividends or share price appreciation to the investors. But of course, return on ROE is quite simple. Basically, you are getting the profit divided by equities. Maybe I will leave it to Dupont to give a very layman concept on what equity is all about, and then what does it represent in a company balance sheet point of view.
Yep. So normally, or maybe I should go to this slide first. So basically, ROE it's can be split down into three criteria. Basically, you take the profit margin of a company, then you times it with the asset turnover, and then you times it with the financial leverage. So if you can look at the mathematic simulation here, net profit over sales times with sales over asset, then you get the sales portion strike off. And then you add in another variable, which is the financial leverage, and there you have your asset over equity. So when you actually cancel off both sales and then both assets portion, you get the net profit over the equity, which is how much net profit a company's business can give back to your shareholders. And equity here mainly refers to the amount of money being raised by selling a portion of the ownership of the company to someone else, and becoming someone else actually become a shareholder or a partial business owner by actually holding on to the company share. So if you manage to have a business that generate a higher profit, so the profit attributable to the shareholders, that means once the company has paid off all the necessary expenses, interest, financing, whatever kind of expenses, then the balance of it is actually equally divided into to the shareholders of the company. So you can maybe have 10 shareholders in the company, each of them holding 10%. And of course, the net profit will be evenly distributed to these 10 personals inside a company. But you can also have a scenario where you have a company being owned by 100 people, but not all of them own 1% each. Some of them can actually own 50% of the company, and the balance portion is actually being split up more among the remaining 99 shareholders. So how much the company can earn and all of it being divided equally in the end to the existing shareholders based on the percentage of shareholding of a company is usually how ROE comes to play when in terms of valuing the business or the profitability that the shareholders get to enjoy and when investing into a company, right? So, of course, this breaking down ROE into 3 subcategories and digging deeper is actually called the Dupont analysis. And do not be too, scared that it's actually another mathematical gimmick to actually derail you from actually investing or looking at the numbers at the company. Because at the end of the day, it's really quite logic on why usually the ROE is being split down and dissected further. So Chun Beng, why do we usually don't take ROE as face value? That means, okay, ROE 20% is good, then I skip to look at other stuff. Why do we dig deeper into the ROE?
I think that's why we have this slide to actually give you a real life example, thinking you yourself as a business owner of a cafe, and then how Dupont analysis can actually help to analyze how your business are doing right now. So the first thing when we talk about the profit margins, right? So it's very simple. You run a cafe, each coffee that you serve, what is the margin? And then this didn't represent the entire thing of your business, because you run the cafe, you need to rent a space, and then people might come in to actually spend time. So some of the people, it may be going in for a coffee, but then they chit-chat with a friend for the entire afternoons. So meaning, even though your profit margin is good, one cup of coffee, you earn 100%. So it's a 10 ringgit stuff, you earn 5 out of it because the cost is 5 ringgits. But then, due to your asset turnover is relatively low, meaning people are sitting there utilizing your assets for a very long time. So the turnover is low. Then meaning, from ROE perspective, if you combine all these three, it will be low, because in order to make ROE hit the very high numbers, then theoretically all must be positive and all must be high in the higher side of number, right? But there is a catch on the last part. So imagine the first two is you can relate because it's like you owning the cafe and then how you run the business. But then the third part is both things you done right, you get a very high score. But then if you can actually score much higher if you have done something on the financial sides. So the third one is actually financial leverage. It's basically talking about the asset over the equities. And then in layman term is how much money that you manage to finance so that you can speed up your expansion or speed up the speed to markets and all those things, right? But the dangerous part is some of the company that offering you a very high ROE, it may not mean their business is actually very good from profit margin or asset turnover perspective. It can be because they are very good in raising fund, non-stop raise fund, and then they can give you a very nice number inside the ROE formula. So this is something that you really need to take notes. Not necessarily high ROE is good. You need to analyze further on the third item, especially. Are they purely riding on a lot of debt to funnels their growth? Are they overly doing it or not? So this is some of the key message or some of the key tricks when you use this Dupont analysis.
Yeah. So I would say, to summarize, profit margin is how much money you can earn on top of selling one coffee. And asset turnover would be how many coffee can you sell in a day, right? So if you have a cafe big enough to sell or to actually seat 50 customers, but only 5 customers appear, so you can only sell 5 coffees a day. So that's not very efficient in running a business. And but last but not least, you also need to take note on the so-called debt the company is taking or not, because too high a debt, if running into certain unfavorable situations or events, can actually pull the company's growth under put it under very, very deep trouble if the company cannot manage the debt very, very well. So to actually visualize the scenario, so we actually come up with an example. So we compare 3 Mamak stores, right? You have original Penang Kayu, Nasi Kandar Pelita, and also SS2 Moni. So we dissect the profit margin and asset turnover and also the financial leverage of these 3 Mamak stores, right? So let's say if I were to just remove SS2 Moni and just compare side by side Penang Kayu and Nasi Kandar Pelita, if you just straight away look at the ROE, you would say that, okay, ROE of Penang Kayu is definitely better because they are doing ROE of 100%, whereas Nasi Kandar Pelita is only 50%. And if I were to drill in deeper, our profit margin, both of them are almost on par, the same. Asset turnover is also on par, almost the same. But when you come to the financial leverage part, you will see that why Kayu is actually registering a higher ROE. It's because that it is more geared. In layman terms, it means that the company is actually taking more debt to run their business, which you can see here by dividing 2 million of assets over 500,000 of equity, you get a gearing ratio of around 4 times. Whereas for Pelita, they're only doing 2 times gearing, which is the assets, the so-called assets is only 2 times the ratio of the equity. So Nasi Kandar Pelita is on a lower debt compared to original Penang Kayu, and because of that, they get the ROE is lower, and you cannot really straight away penalize Nasi Kandar Pelita because of this reason only, because they are in a lower debt scenario. So hence it gives a lower ROE. So these are the things that you need to drill down and not on a face value say that straight away Penang Kayu is a better company because of a higher ROE. So these are the so-called examples you need to take a look at when you compare different companies but from the same industry, so that it is more apple to apple comparison. So what about if I were to flip take Kayu out of the picture and I compare Pelita to SS2 Moni? From here, Chun Bing, even though the ROE now is the same, which is 50%, can I say that both are equally good or one is better than the other?
Yeah, so it's about the same things. If you look side by side, although all the number is not the same, but then from profit margin point of view and asset turnover point of view, Muni done much better. And then the only difference is they didn't actually leverage enough from a financial perspective. So it's the same thing that like what I mentioned in the previous slide is the financial leverage is the one that can misjudge the whole thing. But of course, you can actually take advantage on doing financings, raising fund to actually speed up your expansion, but don't overdo it. So this is how we actually can use Dupont analysis from a right way. It's not just all 3 number. If you need to compare side by side. It's not just if you can hit a very high number means good. So this is the key takeaway for Dupont analysis.
Yeah. So from here, straightforward, SS2 Muni is definitely the better company compared to Nasi Kandar Pelita, even though the ROE is the same. So why? Net profit wise, it is higher compared to Pelita. So Muni is actually registering 40% net profit compared to 25% of Pelita. And then for every 1 ringgit of asset, Muni actually earns 1 ringgit and 25 cents. So it is making every 1 ringgit of its asset to sweat out 1 ringgit of 25 cents of sales. Whereas for Pelita, every 1 ringgit of assets worth inside Pelita's operation can only generate 1 ringgit. So it is more efficient, it is more profitable, and it only loses out to Pelita because it doesn't go take on debt to run its business. So from here, ROE, face value, both are the same, but straight away, if you look down and deep down, drop deeper down into the profit margin and asset turnover, SS2 Muni is a far more superior company compared to Nasi Kandar Pelita. So after going through the so-called basics of ROE, why return on equity is so important, or sometimes retail investors really take a very deeper look into the ROE before investing in the company. But there are also some things that you need to know. After you know the meaning behind how the ROE is being derived, how the company business is being run, you also need to know that as retail shareholders, you and me, we are just actually one of the minority shareholders inside a company. And this is especially true in companies in Malaysia or Singapore or the traditional businesses listed in Asia. The major shareholders are usually the owner. It can be a family-owned businesses, or it can be some very high net worth individuals actually buying into the company and then listing a portion of it into the share market. And sometimes these companies also get the participation from the institutional players like your EPF, KWSP, or whatsoever. So every time, if there is an AGM and if there's a vote, they want to pass something, to pass on certain decisions within a company, it always falls down to the vote counts, right? So say, for example, we talk about how important ROE is just now. If you hold 10% of a company, usually you are entitled to 10% of the profit when the company actually reports its earnings. But this 10% is something you are entitled to. Doesn't mean that you will get this 10% of profit deposited into your bank account as dividends or whatsoever, right? Because at the end of the day, before a dividend gets distributed out, it needs to get voted past AGM. And if it holds a majority vote, then only there will be a subsequent dividend payout. And it also will not be 100% payout on most occasions. So your major shareholders or the owners of a company might vote against or vote for some events or some criteria that might not be too beneficial to retail shareholders like you and me. So even though ROE might be a good factor or good criteria to judge a company, but you still need to actually look at who is actually controlling the company and whether they will make decisions that benefit the small retail shareholders like you and me, right? So maybe if you were to give, if I were to tell you that reality, you might be put off to investing if I cannot control or and am not entitled to the profits of a company. Will I still want to continue to invest, right? So over here, the picture I want to tell you is that you can actually stand back and look at the entire picture. Say, for example, you want to invest in a glove company, listed glove company. There are so many glove companies out there in your Malaysia Stock Exchange, right? So you have company A, you have company B, and you have company C, and they are under different kinds of personalities, different kinds of people who are running the company. Mr. X may be the one running the company really, really well, and you are more comfortable putting your money with Mr. X. Even though both company A, B, C are running the same business, but because of Mr. X principles, Mr. X historical track records, then you feel more at ease into investing into company A compared to maybe company B under Mrs. Y or company C under Miss Z. So we cannot control or dictate how major shareholders would react when it comes to rolling out corporate exercises, but we can choose out of these three companies who are relatively in the same business, the individual who is actually managing the company well or up to our personal preferences, right? So maybe, Chun Bing, you want to maybe bring us through why KayaPlus always wants to talk about management and major shareholder in our articles and in our analysis. Do we do that for fun, or do we want to purposely do that so that our articles are long?
No, I think maybe also a quick sharings. Dupont used to say to analyze a company, there's a 4M you need to check. So later I will let Dupont review the 4M, but then one of the M is representing management. So ultimately, you want to become the owner of the business, and then you can share the profit. It's very important to know who's the one running it. So these are some of the example that we put in, especially for Apples, and they are the one behind them that able to sustain the growth story, even though the key guy behind Apple, Steve Jobs, already passed away, right? So the management team play a very vital role. Although a lot of people say they might not be that innovative anymore after post Steve Jobs era, but like it or not, if Apple still able to produce good products, and then Tim Cook able to spin off with different models of things, and then to keep up with the profits. So this is the things that are able to offer by the management. Very important. Now, of course, on the other hand, we also share the picture of these two Chinese guys, which is from one of our articles, the Kuaishou articles, right? So it's also very important for new company or newly IPO companies. These are the soul behind the whole companies. They will dictate the directions. They will tell you what is the future they will be all about, and then they will realize it. So that's why Bidit is a small company that got listed recently, or a mature company that's already in the market for few decades. Management is a key guy that actually will tell whether this business can give you the future of it or not. And of course, a lot of them have their past track records. You can always check. So, for example, Elon Musk is one of the great examples. He didn't do Tesla from day one. So he actually worked with a few guys and then founded people, and then of course they exit from there, and then they continue on with different ventures. So there was one term called the PayPal mafia, because all the original founder actually went into different interesting startup, and then a lot of it is very successful. So you got Instagram and so on. So you can Google about it. So management is a very key things when you talk about business.
True. And of course, once you are accepted, or you are so truly sold that it is important to also monitor the management, gauge the management, or maybe also the major shareholders, then you might want to ask, okay, so how do I gauge, how do I check that the management is actually, competent enough, the management is actually having the best interest, not to himself also, but also to retail shareholders like you and me, right? So how do we check, or how do we gauge? When we talk about study a company analysis, talk about stock analysis, from the so-called annual reports, usually the statements only reflect the past performance of the business. But how do we also check on the management and the major shareholders? So straightforward, the first criteria to check is the salary, the remuneration package of the management. So how much are you paying, or are we paying this management or this individual to run the company? And is this a good salary to pay someone to run a company? So if the company is growing and the salary tags along with the growth, then by all means it's fine. But of course, if the company runs into trouble, but the management salary still continue to climb up higher and higher, then of course you need to ask some questions whether the management is actually bringing the best interest to retail shareholders like you and me or not. And the second one is actually through corporate actions. So corporate actions, if the company runs into certain kinds of situation, what are the kinds of corporate actions that they will roll out. So say, for example, they want to expand the business. Are they going to do it via debt financing, via equity financing? Or if it chooses equity financing, will it be through rights issue, or will it be through private placements? So all of these are part and parcel of how do you gauge a management or a key executive, whether they are competent enough to lead the company or not. So another one is straightforward is through track record. Basically, what they say or what they promise actually comes true. It's not just empty talk, right? So for those who have been invested in the company, in the share market for quite some time, you would be aware of this individual, Dr. Chia, who is the executive chairman of QR Resources Berhad, right? So this is an excerpt from the latest QR Resources annual report. You can see here, 2020, page 24. So he says, 20 years history, we have sailed through headwinds and tailwinds and still being able to deliver year upon year of sustained growth. So he himself has said that, okay, for the past 20 years, it wasn't a smooth year, but still every year we managed to grow and deliver sustained growth. So straightforward, this is one point that you need to audit. Is this Dr. Chia actually talking cock, or maybe really putting his words to action? So you can see here the snapshot of QR Resources annual performances. It has always been growing, right? From 2012 all the way to 2020, his word really turns into action. So the company really managed to grow. Even though 2020 was a tough year during the pandemic, you can still see the company actually never stopped growing, right? It still managed to break the historical high of previous year. And as always, and expected, under the tenureship of Dr. Chia, it would be expected that QL will still continue to outgrow its revenue year upon year if they continue doing what they are doing and continuing to reassuring shareholders that it's okay. And if I'm still around managing the company, I will always ensure that the company will have sustainable growth. So from here, the numbers from the annual report ties back to what the management is talking, and you can be well assured that this management is actually walking the talk and having the proof in numbers whenever they promise something. So does that also translates to good price movement as well in the share price, Junbei?
Yeah, of course. I think when the profit is there, the sales growth is there, the very direct reflection will be the share price. So that's why it's very important to tag along with a company that have future growth, future potential, and then also have good management. So I think you didn't mention the 4M they're supposed to review. It's actually money management and what's another tools?
The margin and the moat of the company.
So I think this is very easy to remember. I mean, moat is basically referring to the business model, whether you have advantage in terms of regulatories or advantage of because of the skill that you have. So for example, Tesla can be having a very good business mode because they are first mover into the market, and then also backed by some electric vehicles policy in certain country to boost the sales. So after you have this kind of good model, then the next you talk about is actually the margin. Whether all these things protect you, are you able to sell it in some price that can give you a very good number in terms of returns? Okay, these two pass. So the third thing is whether you can actually sustain the growth and then continue to bring in more and more things. So this is the people behind the scene called the management are able to actually tell or give you the certainty. And lastly is money. Money is also related back to today's sharings when we talk about the financial leverage. So are they getting enough cash? Are they utilizing the cash to do more things? Are they borrowing too much money? Are they giving out dividends? So this is all the key information that can help you to gauge a company in a very fast manner.
This is precisely true. And of course, KL Resources, like all the other competitors out there, Lei Hong Berhad, CAB, right? They are all in the poultry business. You would notice that the way QL Resources is being run as a business is far, far, far more efficient and more profitable compared to their peers, right? So even though it's the same business, like I mentioned, it's a company A, company B, company C, all three might be in the same, relatively same business, but the management of the company, be it Mr. Y, Mr. X, or whatsoever, the company's management is the one that can actually bring a difference to the company. So it really takes someone with guts and also with vision to actually say that, okay, I'm doing this, then I can actually come up with a new vertical, and there is some synergism within this new business vertical with my existing business vertical, and that can actually bring the company to the next stage or grow the company further. So if you compare QL Resources against the other peers, you will not find someone as predictable and also as lucrative like QL Resources. So there are a lot of poultry companies out there, but none of them is more well-run and more visionary, has a more visionary management like QL Resources perhaps. So maybe due to that factor as well, the price or the PE ratio or the valuation of a company is relatively higher because people are more well reassured that this is a better company and they're being willing to pay a higher price to buy or to become a shareholder of QL Resources. So this is actually how you zoom down to a particular collection of companies of the same business, but you manage to identify the potential winning horse of a long race. So it all ties back to not only how or what the business is all about, but also the owners of the company and also the major shareholders are there also in sync with the retail shareholders' perspective, right? Are they diligently running the business, continuing to create value to themselves, to the company, and also to the retail shareholders? And of course, just to also give you guys a little wake-up call, if you look at the richest people all around the world, as of now, 2021, all of them own successful businesses, right? Their businesses may be listed companies, they might be also unlisted companies, but all of them are businessmen and they own a huge stake in the company that they are executives in, or they might be actually, having the wealth being transferred to them because they are the heir to a certain business. So the parents or the husband passed away and they actually are the so-called key beneficiaries by actually being the so-called person willed on to hold on this ownership in these big businesses. So these are names that we are not strangers of: Jeff Bezos, Amazon, Elon Musk, Tesla. So you don't see property gurus up there, you don't see cryptocurrency speculators up there, and this is why we still are very confident into being shareholders of good businesses, because the richest people all around the world are all business owners, and they derive their wealth by actually ensuring the company is well run, and also that being potential small shareholders of this company can also make our investment returns, something to actually anticipate when it grows 10, 15, 20 years from now, right? So, Junbei, I believe that most of the people here are people that you are also familiar with.
Yeah, of course, I think it would be good if we can be one of them. I mean, in a smaller scale or whatnot, but starting a business is all about, they come with a lot of factors. I mean, whether you are good enough, you able to get the right team. Imagine you've done all these things right, you still need a good timing. So let's say you wanted to do electric vehicles 10 years ago, you're very smart, you have the right technology, it's just not, the timing is just not right, you might not be able to succeed. So while you continue to work hard in your daily life to be really serve as an employee or whatnot, one of the easy way to participate in the growth story of the business or participate in the growth of economy of a country or whatnot, share market definitely is one of the best place for you to go in. A few clicks, then you can actually join the growth story. But of course, it also takes hard work for you to analyze the business and whatnot. So another key things they wanted to share is, I think I shared this last week as well during the Not So Late Night show. It's talking about how a businessman do their business. Typically, they will repeat the same style when they go into the next ventures. That's why when you compare Serba Dynamic versus K-Power, I would say eventually they will go into a very similar kind of performance. The only difference right now, K-Power seems to be very good. I mean, performing very, very well. I think late last year, due to the fact that it's in a very newer or greener industry, securing a lot of contracts. But then this is the same thing that Serba Dynamic able to show you during the earlier day of when they get listed. So this is also one of the ways for you to gauge something. So K-Power is very good example to compare them against Serba Dynamic. So because if you have certain similarity in it, but of course it might not be true 100%, but you can always take this as a very great example to monitor or to follow as a guide before you invest into company of a few fellows that run a few successful business. So you know their styles, and then you know whether it's suitable for short-term or long-term holdings.
Yep. So after we talk about how or why we look at ROE, how you actually gauge at the management, and how we also get to see that not only retail shareholders can profit from the share market, the owners themselves actually get their billionaire status from holding majority of their wealth in the company shares. So we see how or why Elon Musk can suddenly become the world's richest man currently is because the appreciation in Tesla shares, and he has a lot of shares in Tesla, right? So not only Elon Musk can become the richest man by holding Tesla shares, or we can also become a potential good, I would say potentially millionaires lah, if you actually do your stock selection right and you actually have a so-called detailed thesis why you want to invest in a certain company and why you choose to actually invest in this particular company. And also why company owners or even the so-called founders want to IPO their companies in the US market. So there are so many exchanges around the world. All exchanges allow businesses to list a portion of their shares in that market, sell a portion of this ownership to the market, and they can get money from selling the shares, and then this money can be well utilized to grow the company. But why all companies around the world seems to find it so attractive to IPO in the US market? So first thing, very easily, is because of the attention. When you actually list your company on a US stock exchange, you are actually getting worldwide coverage. A lot of brokerage around the world allows or provides the so-called freedom to trade or buy and sell stocks listed in the US share market, not just US companies, but also Chinese companies listed in the US and also other companies as well. So once you actually manage to list on the US stock exchange, you are getting straight away attention from all around the world. And one of it is a Singaporean company, but did really, really well last year due to the pandemic is Sea Limited. The share price actually went up more than 2 times because of the so-called increased frequency or the increased intensity of the e-commerce section. So C Limited is the owners of Shopee, and you can see that even though company has not been making any profit, churning out any profit, but the growth actually caught the attention of people all around the world, and people started investing or buying the company shares, and that's why the company share price actually grew way much faster, and still is considered at the high side, right? Companies like C Limited might not be so popular if they're listed locally because less attention as well. And of course, you're not actually opening yourself or selling yourself to the whole wide world. Instead, you're just selling yourself to Malaysians only if you just choose to list your company shares in Malaysia. So this is why usually people or major companies want to list their shares in the US share market to command more attention and also command more premium, right? And of course, once your company share is high, and if you run into, liquidity issues, it is very easy to actually raise more money. You just do a rights issue, just like what Tesla did back then, and suddenly they have more cash to continue to spend on the operations side and also the R&D side. So it's very, very easy to get liquidity, get funding in the biggest stock market in the world. And this is also one of the reasons why companies always wants to choose to IPO their shares in the US stock market. So, Chun-Ming, I guess that the individuals here are not, I would say, billionaires already, right? So, why do we always say it is important to look up to those, to most of them, I would say?
I mean, if you cannot beat them or you join them, I will summarize it in this way. This is the best way. Instead of you complaining what Mark Zuckerberg is tapping on selling people personal data, privacy data to make him rich. You complain all these things, but you didn't take action. He continue will be the one of the richest guy in the world, and you get nothing by just doing complaint. So why don't you just join them and then enjoy the returns from it as well? So this is one of the key things that I always look upon. So beside good business, it got to be good management. It will be good if it's the visionary one. So I think lately I like how Microsoft CEO managed to turn them around. Ever since he take over from Steve Ballmer, the one that actually replaced Bill Gates previously. So you can see it really make an impact. And then ever since he stepped in, the share price really went up. So continuously until today, although there's some correction, but ever since he's in, if you invest during that time, you must be a very happy investor of Microsoft. I think easily got 100% and I think more than 100%.
Yep. So, well, from what I see is that all of these individuals, or most of them, they are still very hardworking. They still continue to innovate and come up with different ways to actually grow the business. Of course, Bill Gates and Jeff Bezos are now more on the backseat. But you talk about Elon Musk and Mark Zuckerberg, they are still very the mastermind of the company. They still play very, very important roles in the future of the company, right? So when they continue to grow their business and also in the process of their net worth, we can hopefully become the millionaires by investing a portion of our wealth or savings in their companies. So this is how retail investors invest. Not only you want to justify the fundamental analysis or the so-called financial statements of the company is good, you also need to know who is actually running the company, because a good company can actually get destroyed by a not so responsible management. So we talk about, historically, there are also strong countries or strong civilizations that crumble under weak kings and weak leaders. So although they are not so as of now, in the present world, you don't get to see all of these civilizations crumbling, but the key message also plays into each company's fortunes and future. You still want to have a strong individual who is visionary and also wants to grow the company much more and much hungrier than the retail shareholders. That's only when the company can actually survive in a very, very highly competitive world.
So I hope you really enjoyed the lesson and the video. Don't forget to click like, subscribe, and also turn on the notification bell button to get notified whenever a new video like this gets posted in the future. Of course, there are other Premium Club services that you might really want to check out, and check it out by subscribing to our Premium Club members, link in the description. See you in the next video. Bye bye.